Hey, what's going on, everyone? Welcome back to another video. Today's video is going to be on mitigations in forex and what these mitigations actually are. Now, I've seen a ton of videos on YouTube going over mitigations, and there's some pretty good informative videos out there, but I wanted to simplify a little bit more because it tends to get a little bit confusing, and my job here at Traq is to just make things simple as possible. Like I say, simplicity is key. So let's get straight into this video. Number one, what is a mitigation? Well, to know what a mitigation is, we're going to have to understand what an order block is. Now, I have a video on order blocks. If you haven't already watched it, go onto my channel and watch it. I have a ton of videos on these, so after you're done watching those videos, come back to this one and everything will make more sense. But let's talk about mitigations. So first of all, what is a mitigation? Well, a mitigation is the idea that the market or the market maker, such as the big money, right? People with a lot of money, not just me and you, not people that, create a broker, but deposit their 500 USD and then come to the markets. I'm talking about market makers with billions of dollars to trade with. These market makers, they have buy orders and sell orders all over the market. Literally, when we're looking at this chart right here, right? That means that market makers, people with big money, they have buy orders and sell orders random points in the market. That's initially what the basics of mitigation is. That's what we need to know before we get into what a mitigation actually is. So we need to remember that the market maker has buy orders and sell orders all over the market. Now, we all know that if you take a buy, for example, right over here, right, and then you start taking a sell over here, the buy is going to be in profit, right? Or sorry, I completely did this wrong. Let's say we have a buy over here and a sell over here. There we go. This makes more sense. Now your buy is going to be in profit. But due to the fact that you took a sell position at the same area where you took a buy position, your profit is going to even out with, and it's going to turn out into a break even or a loss. Because you can't be in a buy and sell at the same area at the same time. It just doesn't work out, right? And you're either going to lose some or you're going to just be at break even, and it doesn't make sense at the end of the day. So what these banks are actually doing is they're pushing price back down into where they're interested into putting more orders. Now, I know this is a little bit confusing, but let me break this down. So let's go down to a brand new chart, Euro USD. Let's go over here. Let's go to the monthly chart. Let's just stick to the monthly chart because the monthly is a lot more easier to understand. Actually, we'll go to the weekly chart because the weekly is easier. All right, cool. So number one, we can see that from this point up to this point, Euro USD was extremely bullish, right? Now, what does bullishness mean? Bullishness means that demand is increasing every single time. As price is continuously going up, demand is going up. That means that there's more demand in buying the currency than supply in selling the currency. So that means that market is bullish. Now, it reaches this point right over here, and at this point, the market finally reaches its climax, aka its consolidation, and it decides to start selling off. And this is where supply exceeds demand, meaning that supply is greater than demand, and there's more sellers looking to sell the currency rather than buy it. Now, what we need to focus on is the area that created this major move. Now, this major move down that happened right over here, we need to make sure that these moves carry two things. Number one, actually three things. Number one, imbalance. Imbalance is extremely important. Number two, it has to carry a break of structure, meaning that in this case we have a higher high, higher low structure forming here, and right as soon as we came into this point, the market started selling off, and not only did it sell off, but it broke structure right over here. So that means that your area where you're looking as a supply zone or a demand zone or your mitigation point, the market needs to break structure. That's number one. That's number two. And number three, the move down has to be with a lot of momentum and volume. That's the main thing. It has to have a ton of momentum and volume, because these big candles that we're seeing here, this is an essentially order flow. For example, over here, you could see that there were more sellers looking to sell than people looking to buy. And how do we know that? Well, because look at how quickly the market sold off. It moved into a flash. And then at this point, we had this area where the market was kind of in a consolidation. We're still moving down, but it was in a more smaller and, I guess I would say less faster way. And this means that order flow is slowly slowing down. That means that there's less sellers, but there's still more sellers, just less sellers compared to before over here. So that's number 3. You need to make sure that the market is going down in a really strong move down. It has to be going down in a strong move. Now let's get to the order block part. Now, like I said in my previous video on supply and demand, a supply zone is basically just the top of a consolidation to the end of the consolidation, and it's just a big zone where the market sold off from. Now the order block is basically just a refined version of that, meaning that instead of taking the big zone, we're going to take the last bearish or bullish, in this case going to be bullish, we're going to be taking the last bullish up candle before the major move down. Now before we get into this mitigation thing, let me explain what's happening over here. So institutions, they were looking to buy, right? As we know, the market was pushing up. They were looking to buy. That means that every single higher low or every single opportunity slash chance they had to buy, they were adding onto their buy position. So that means that over here they have a couple buys, over here they have some buys, and then over here they have some buys. Now they can't keep buying forever, because at one point everyone's going to realize that the market is just trending up. And if the market is trending up, everyone's going to buy, right? I'm going to buy, you're going to buy. My math teacher who doesn't know shit about forex is gonna buy. Everyone's gonna buy, right? And it just doesn't end up working out, because if everyone's making money, the market maker essentially loses money, and that's just how the concept works. So what the market maker does is it has its levels where it already has its levels, knowing where it wants to start buying and where it wants to start selling. Now it's harder for us to identify where those levels are gonna be until after the market gives us some clues. So let's assume that the market is continuously buying and buying and buying. Now, up until here, right into this zone right here, this area of consolidation. Let me highlight this right here. This area of consolidation. This is where the market finally decided that it wanted to stop buying, and demand was just, there wasn't any more demand. They weren't interested in buying the base currency anymore, and they're rather interested in selling it. So what they did is they started consolidating price, right? And you could also see some Wyckoff here. This is why Wyckoff is important, because this area of consolidation, it tells you information. So that rhymes. All right, but basically this area of consolidation is where the market is going to first give you its first clues that we're looking to sell now. And that's where they're going to start adding their sell positions. But you have to remember one thing. As they did add to their sell positions, they also had buy positions waiting in here too. So that means, like I told you guys before, you can't buy and you can't sell at the same time. So what the market has to do is it has to push price down. It has to push price down. That's number one. After the market finally goes down, this is where we have to use the order block concept in order to understand mitigation. So number one, we have our supply zone, right? Our supply zone is right here. Now we need to find our refined supply zone. And the refined supply zone is simply going to be this last bullish up candle before this big down move. Now this is going to be your area where you're going to be looking to find the mitigation, basically the order block that's refined inside of the big supply zone. Now what's happening is the market basically was selling off, right? We sold off. A bunch of people are selling, meaning not people, but big people with big money. They're selling. But at the same time, big investors also had buy positions in here too. So what they're going to do is they're going to push price back up into the area where they bought and sold, and they're going to close their buys and then continue to add on to their sells. So for example, all these buys that we see here, right? They're gone. They're gone now. As price pushed back up, they closed their buys, meaning that the market maker pushed price up into here and they closed their buy. And after they closed their buy, what did they do? Well, they added on to sell positions. And this is where the order block concept works perfectly. They add on to sell positions and then they push price down into where? Into the next mitigation point. And the next mitigation point could be simply over here, right? Where we have this area of consolidation and the market could sell off into here, and same thing could happen. We'd be looking to refine the area of the last down candle before the major move up, and the market would simply refine this institutional candle and then go up from there or go down. It all depends on structure, but that's essentially what mitigation is. Now if we're looking at mitigation from a higher time frame perspective, things get a little bit confusing. Now let me explain what I mean by that. So we could see that the market was selling off, right? Selling. Now as soon as they came up to this point, this is where they started to consolidate price, and buy, meaning they were interested in getting into buys instead of sells. So what they did is they added on to buy positions, but at the same time, they were holding sell positions all the way down into here. So what do they have to do? Well, same thing. They have to push price down into that area where the demand zone is. The demand zone is basically the area of consolidation from the high to the low. Now, how are you going to find your order block? Well, it's the same concept. Find the last bearish, or in this case bearish, find the last bearish down candle before the move up, and that is where the mitigation is going to happen. And that's how you're catching these big entries. Look at this. Market taps in perfectly, and then it moves up. Now, what I want you guys to look at also is that the market tapped inside the area of supply zone. It tapped in the supply zone perfectly. But then you might say, okay, but why did the market just, go back down and then go up? Well, something that I forgot where I heard this from. And if someone knows who said this, please leave their channel link below, or maybe it was a person, but I forgot who I heard this from, but I heard that basically these areas of supply and demand is not just one market maker buying and selling in here. The market maker is fighting against other hedge funds and institutional banks. So it's our job, or not our job, but it's their job. Millions of banks, it's their job to mitigate every single institutional bank. So I'll give you an example of what I mean. Let's say there's 3 different banks: Traq Bank, Forex Bank, and then YouTube Bank. Let's say YouTube Bank bought right over here, but then Traq Bank bought right over here. But then what was the other one? YouTube, Traq, and Forex Bank bought right here. That means that the Forex Bank, their main thing is going to be to mitigate their position right here. But then there might be another bank that bought even lower, that sold even lower, and they want to bring price lower so they can mitigate their sell position. And that's the theory on why the banks bring price down to the 50% of an order block sometimes. Because sometimes there's institutional investors that are invested lower in the order block, if that makes more sense. So after we mitigate all those sell positions, meaning sells are gone, what do? Well, they start adding on buy positions, and then they push price up, right? But now you have to remember one more thing. They sold from this point down to here. So what does that mean? Well, that means that they have sell positions resting in the next area of consolidation. And that next area of consolidation is where? Well, it's right over here, which is the next area of demand. So that means that now they have sell positions that they were holding all the way down into here, but they also have buy positions that they're holding in here. So that means that the market just has to come back down, find the last bearish down candle before the move up, mitigate it, and then it can make its next move. And I'm assuming that what's going to happen is the market's going to come into here, probably go back up to mitigate this institutional candle or this area of supply or demand, and then it's going to continue lower. And that's the theory of mitigation. That's all it really is. It's really simple. Now, this is on the monthly time frame or the weekly time frame, so obviously it's a little bit far-fetched and it's going to take years for these types of setups to play out. But you can use the same ideology on the 4-minute time frame or the 4-hour, the 1 minute. It's just about how you implement it. So I'll give you another example of how you could use this on the smaller time frames. So right over here, like I told you guys before, let's implement all the different other concepts we have inside of this mitigation. So we have this mitigation point right here with this area of order block. Now the market taps inside of it, right? Now, we know as institutional traders, we don't enter just because there's an order block here. We enter after we wait for confirmation. So what do I always say? Well, I'm going to break this down step by step. Number 1, find your institutional candle. That's it. Find your area of interest. This is my area of interest, right? Why is it my area of interest? Number 1, we have a supply zone. Number 2, we have imbalance here. Number 3, it created a strong move down and it gave us a break of structure. And number 4, structure is shifting bearish. So that means that I can actually have valid reasons into selling in this area. So let's do that. Let's wait for price action to enter that area. And now I enter the area. Now what we have to wait for now is we need to go down to the smaller time frame, which would be the daily, the 4-hour, and look for structure confirmations confirming that the market is actually ready to go down. Because you have to remember one thing. The market was bullish for the short term to go up. That means that inside of this weekly, range towards the upside, there's daily time frame structure that needs to be broken and invalidated in order for us to take this short down to the downside. Now remember, if the weekly is bullish, that means the daily is bullish. If the daily is bullish, that means the 4-hour is bullish. If the 1 hour is bearish, that means that the next time frame that's going to be bearish is the 4 hour. If the 4 hour is bearish, that means the daily is going to be bearish. And if the daily is bearish, that means the weekly has to be bearish next. So what we need to do is we need to identify structure with this mitigation strategy. So let's go down to the daily time frame and let's just break this down. Let's see what price action does. Obviously, it rallies inside. And then we go towards the downside and look at what we do. We created this higher high, higher low uptrend. Right here, clean, higher high, higher low. And this is basically just the market saying, yo, I'm bearish or I'm bullish, right? I'm in a buy side uptrend. But after I tapped inside of the area where there's an order block, I decided to go bearish. And that confirms that your area of interest or your point of interest was actually correct. So now we know that the daily is shifting structure. That means that it's time for the weekly to shift structure. So if the daily is shifting structure, where's the next point that the market can head to? Well, we're going to have to look in terms of where the next mitigation point is going to be. And if we go down to the monthly time frame, we could confidently say that the next mitigation point is going to be all the way over here. I can say that confidently, my bad. So let me go back to the daily time frame. I'm not sure why my PC is so laggy right now. Hold on, let me just quickly refresh this. I'm not sure what just happened. All right, there we go. So, oh snap, I have to go back. My bad. Let's go back. We were right over here, I think. Yeah, we're right over here. All right, so there we go. Now that we had our first actual mitigation from the weekly time frame, right? We mitigated the weekly institutional candle. Now there's a new mitigation point. What's the new mitigation point? Well, look, the market was still buying from this point up until here, right? And then after it tapped inside of our institutional candle, what did it do? Market started selling down, right? It makes sense. So that means that the same concept, the same rules that applied on the monthly and weekly are applying right now. So let's look at our 3 rules. Number 1, is there imbalance? Well, let's go to the daily time, or let's go to the 4 hour because the daily is a little bit too much. And yes, there's a ton of imbalance here. You could clearly see that there's imbalance resting right here, right? There's imbalance. Honestly, I wouldn't say there's imbalance there, but there's imbalance over here, right? There's imbalance everywhere, especially inside of our point of interest. So that's number 1. That's one confirmation right there. Number 2, do we have a shift of structure? Well, let's take a look. Higher high, higher low, higher high, higher low, higher high, lower low, lower low, lower high. So yes, there is a shift of structure. And was the move down strong? Look at order flow. Definitely. Look at how strong that move happened. And all this, the market moved from 1.23 down to 1.19, all in 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, almost a month. And that's pretty good. If you think about it, that means that bears were in charge for 1 month straight. So what are you going to do? Well, find your institutional candle. Well, that means we might have to go down to the higher time frames. Go to the weekly and see if we can find something. Now on the weekly, we could see that there is a big area of interest right here, right? A big area of supply. Right over here, this last bullish candle before the move down that broke structure. Now let's go down to the daily, see if we can refine this a little bit more. Now on the daily, it's not too clean, right? But remember, you could use the other time frames on the daily. So you could use the second daily time frame, right? And on the secondary time frame, you could refine it up to here, and that just looks so much more cleaner, right? You could even go down to the 12 hour to refine it a little bit more. I would just stick to the second daily time frame, right? And now we know that the next mitigation point is gonna happen right here because markets were buying into here and then they started selling down. So now we have confirmation because the monthly shifted, the weekly shifted structure. Now the daily is shifting structure, and now we have our mitigation point. So all that's left is you could do 2 things. Set a limit here because now you have proper reasoning to actually sell with a stop loss at the high, and then your TP all the way back down to the next mitigation point, or wait for more confirmation. And let's take a look at what happens. Well, we already know what's gonna happen, but okay, and then the market taps in, and we could just look at how perfectly it taps in. Look at this. Look at how perfectly it taps in and then sells off. Now someone might say, okay, Traq FX, how come you're catching this entry when I'm catching an entry right here and I'm going in drawdown? The reason you're going in drawdown is because you need to wait for 2 mitigation points. This is the rule of forex. This is the rule. The rule of forex is wait for 2 mitigations. So this is the first one right here, number 1. And then this is the second one. After the second mitigation, you can set your limit. But in order to be able to set limits, you need to wait for the break of structure. That's number 1. Number 2, strong move down. Number 3, imbalance. That's it. And then you're not going to be, catching this big drawdown move down. Instead, you're going to be catching the entry right away. That's going to go down towards the downside. And that's how you're catching it. Now, let me actually go over a trade I caught myself. Now, this trade I did not send to the group chat. But, in fact, I actually took an L trying to buy over here. And, that was just a stupid mistake by me. But let me go over this trade. So, number one, the mitigation strategy, it works on every time frame. It's all about how you implement it. That's all. That's it. It's just about how you implement it. So let me break this entire thing down. Let's go from here. So let me delete this, delete this, delete this, delete this, delete this, delete this, and delete this. So number one, the market was moving in a downtrend, right? Is moving in a downtrend. Now, when the market is moving in a downtrend, like I said before, the market has supply at every single lower high. So right over here, we can see that there's a lower high. The market created a supply zone. Over here, it created another lower high. It created a supply zone, right? And basically, the market is creating multiple lower highs after it sells off, and it mitigates the supply zone before it continues down. Now, the pattern is right here. We go down, we consolidate, we go down. And then we go back up into that consolidation, and then we go down again. We break structure right here. And then we go back up into that consolidation, and then we go back down. Now, what happened over here is we didn't get that retracement, right? Because look at this. We're getting the retracement here. We're getting the retracement here. But we didn't get the retracement over here. That means that this area is unmitigated, right? This area is mitigated. This area is mitigated. But this one right here is unmitigated. And if you go down to the 30-minute, maybe you could get an even better. Yeah, there you go. There's a pretty clean institutional candle right here. Last bullish up move before the move down. And what's interesting is that it gave you a break of or a continuation of structure before the market ever retraced back. So what I mean by this right here, we have a low, market breaks that low, and then it comes back into the area with the last up move before the move down. Right here, we have another low. We break that low, and then it taps into the last up move before the move down. Right here, we break this low, but it doesn't tap back inside this up move. That means that this is an unmitigated area that the market has to come back to, right? So then now I'm going to be using my Asia range strategy, which is the Asia liquidity lows that I talk about. So now let me take a look at Asia session. Now, going down to the 3-minute time frame, you could see that this is the Asia low. And and by the way, I completely forgot to say this. The market was in an area of interest from the 5th daily time frame. Right over here, the market was in an area of interest, which is why I was looking for buys and sells. But let me go back to the 1 minute. So after the market tapped in, we created this Asia low. And if the market ever creates an Asia low inside of your point of interest, just know that point of interest is going to get rated. It almost has to get rated. It just has to. That's just how the market works. So then what I said is, all right, bet. I'm also noticing that there's a, what do you call it? There also is a Wyckoff redistribution. Oh no, just a distribution, not a redistribution. There's a Wyckoff distribution schematic forming in here, right? So I could see right over here, we have our PSY. And this is an improper one, by the way. You have your buyer's climax. Or sorry, my bad. Buyer's climax is up here. PSY is right here. You got your PSY buyer's climax, automatic rally right here. You got your secondary test, right? And then you have your final UT. So this is a type 1 schematic. You have your final UT. So at this point, I was thinking, all right, cool. Let me go down to the Oh, I think I may have done this completely wrong. Hold on. No, I didn't. All right, cool. So then what I'm thinking is, all right, bet I need the market to come back up into here, and then I can look for sells. So then I found my institutional candle, which was right over here, right? This is my last area of interest that I'm looking to get mitigated before I actually buy or sell or do anything. So then I just started refining, and what I found was this run right over here. This last institutional candle before the major move down right over here, and it has imbalance. It broke structure. It moved down pretty strongly, and it's unmitigated. So that means that it makes sense for me to sell here. And you could have even refined this a little bit more if you wanted to. I'm pretty sure. I think if you did refine a little bit more, that would have been a little bit too excessive, but it still works out. Now let's not waste any time. Let's just see what the market ended up doing. And right over here, you could see that price action ended up. Oh, my bad. Okay, so it looks like my entry was a little bit higher, so I did refine it up to this point. So let me actually take a look at where I refined it up to, because I'm a little, my brain is a little foggy right now. Okay, now I completely remember. So what I did is I found my institutional candle, and I measured the entirety of the institutional candle, and I took the 50%. I took the 50% of this IC specifically because I wanted to have a really nice entry with a little bit of drawdown. And look at what happened. Like I said, you have to wait for 2 mitigation. So the first mitigation is right here. This is the institutional candle, right? So let's make a zone. All right, cool. Now we have our zone of mitigation. Now look at what happened. The market almost stopped me out because I didn't wait for confirmation, and I had to wait for, I didn't wait for confirmation. I had to go through the drawdown. Now look at what I could have done if I waited for confirmation. So price action goes up, creates this higher high, higher low, right? And then we finally have a strong break of structure right here. Strong, nice break of structure. All I needed to do was find the next mitigation point. Next mitigation point is right over here, and I could set a limit right there. Stop loss would be the high of the order block right over here, and you would have missed it. You wouldn't have got, sorry, you would have missed your stops. You wouldn't have gotten stopped out. And look at how much the risk to reward just changes in a significant amount, all the way like, so it went from like a 33 to 1 into like a, what is this? And we targeted the Asia session lows, by the way. The reason we targeted the Asia session lows is because we know that the market left it here to rate it. If the market leaves an obvious Asia session low like it did right here, and it's inside of an order block, it's going to get rated. Remember that. So we went from a 33 to 1 into a 100 to 1 just off of waiting for confirmation. But sadly, I didn't do that, but it still ended up playing out just like I expected to. But that's basically the theory of mitigations, and it's really simple. Remember the rules. These are the 3 rules you need. You need to stick to these 3 rules. Number 1, the move down needs to be strong. Number 2, there needs to be imbalance. Number 3, it has to break structure. And number 4, don't just set a limit at the mitigation. Set the limit at the second mitigation. That way, you're actually waiting for confirmation, and you're going to be getting in at the perfect time. And look at this. This was a clean 32 to 1. So thank you guys so much for watching. I hope this video was helpful. And yeah, if you guys have any questions, please feel free to leave them in the comments below. I'll try my best to get back to all of them. But yeah, peace out, guys. Thank you, and have a good one.